Hope everyone had a delightful lunch. It is 1:15 on Wednesday, the 31st. I don't think I announced yet that tax season started yesterday or Monday. What day of the week is it? On Monday. And there was a really great press conference last week about the earned income tax credit and the child tax credit that the tax commissioner spoke at to try to spread the word, and lots of opportunities for folks this tax filing season. So we're going to start with H 827. Kirby has made a few revisions. I don't know if folks remember, but when we first started working on the bill, I took responsibility for the fact that Kirby essentially started his job and I handed him a ridiculous project. And so has made some revisions since then of sort of what he would have done with more time. So we're going to share those. And then Professor Gamage, I actually realized I don't know how to pronounce your name. Great. Professor Gamage is going to join us to give us some more context and explanation on the mechanisms of the bill and why they work. So with that, Kirby, would you like to join us?
Good afternoon, everyone. Kirby Keaton, Legislative Counsel. So as the chair just mentioned, we have start of a committee amendment for H 827. I would say most of this is housekeeping stuff, but I'm going to walk through all of the things that we changed from the original version. And then for one of these changes, I'm going to elaborate a little bit on something that came up in our last discussion as well, because it's related and important. So for this amendment, the first change is, I believe, on the bottom of page 3. Is the size good?
It's a great size. Thank you.
Okay, so I'm going to start zooming through, so you may not want to look at the screen. Okay.
So we're supposed to be looking at the Ways and Means Amendment.
That's correct.
Thank you.
Okay, so first change here, this sub E and F, those subsections were in the apportionment section before, but it was more appropriate to move them up into the enacting section, the first section of the bill. So it's just a moving around of some subsections there. And for one of the things that were moved, I had to clean up some language where there was the same phrase was used twice in a row. So it was just a typo type thing that was changed. And then on page 8, we have a new subsection being added. And this is to clearly link up an area of possible confusion. So if we remember last time, Representative Brannigan had mentioned the idea of what happens when capital gains tax is later paid after unrealized gains have been taxed by Vermont previously. And I had said that there would be Vermont income tax applicable, but that has a lot to do with the fact that H 827 partially taxes the realized gains. So there will be some gains that weren't taxed yet, and then they would be taxed on at the time of like a capital gain. But I did not point out that, so there's something called basis, which you don't apply tax to when you tax capital gains. And this bill does track the basis and reduces the amount that can be taxed in the future when the unrealized gains have been taxed. This provision right here makes it very clear that when we go to do personal income tax later, when there's a capital gain, that the basis from this bill will be incorporated when we decide capital gains later. So in short, no double taxing.
Okay, so
Yeah.
The gain that you've paid tax on in accordance with this bill becomes part of the basis or does not become part?
It, by the amount that was taxed is included in the basis, which means it's not taxed later.
Yeah, okay. Okay, that's included in the tax. All right, thank you. That's helpful.
Representative Woody.
Thank you, sorry. I need an example. Exactly. an example.
Well, okay, a simplified example could be, you own a building that appreciates in value 1 year, and you're a taxpayer who has so many assets that the unrealized gains tax would apply to you, right? And say you pay unrealized gains, I don't know, $20,000 worth of tax. I don't, that might be too large of a number, but
You give the amount of the building, the amount of the unrealized gain, the amount of the tax like that, because I don't want to not understand this.
I'm afraid to use numbers like that because like I don't have an accounting background to do that. It's just to say that whatever the number is, that the amount attributable to that gain, where income taxes applies, the unrealized gain, that amount of value will not be taxed again later.
Oh.
So you're tracking the value of the asset, and we will not apply income tax to the same amount of value more than once.
Our next witness might be able to give us more examples, and I think this is sort of the kind of bill that we might need to sort of run through explanations from various people in order to get our heads fully around it. Also just like a housekeeping thing, I see people raising their hands to jump in when like people are very mid-sentence, and I know it's to get in a queue, but sometimes it feels like we're interrupting each other with our hands. So I feel like there's some nuance to that, and I don't really know what it is. It's just like a vibe I have right now. So Representative Sims and then Representative Brannigan.
Who is tracking the value of these assets? It's like tax coming and looking at my art collection and determining that my art collection is worth more than it was the previous year.
The taxpayer is tracking and submitting values. The department could look into that. And there are parts of the bill that require some tracking of values for things we haven't gotten into, like deferral accounts. And that would require some further tracking on the department's part too. But for your question, it's the taxpayer declaring values.
I'm self-reporting my total net assets and any appreciation of those.
But the bill does spell out how to do that.
Yeah, I wanted to just ask doesn't that mean then that the advantage whoever it is that inherits the property is getting goes away because you're paying tax on it and it goes back into the basis, which he would not pay tax on anyway because it's the basis. So
You would, if the unrealized gains wasn't taxed, it is reducing an amount that otherwise you would pay tax on for capital gains.
because you've already paid tax on it. That's why it's reduced. It's being paid, the tax is what we're contemplating here. That tax will, if this were to become law, that portion of the property's value would be taxed and you'd pay it.
It's the timing of when I would say it's not the amount that it's taxed. It's the timing. With the unrealized gains, with this bill, it would be taxed, some of the value increase, just a portion of it would be taxed earlier than it otherwise would. But when that happens, when taxes due later, it is reduced by that amount again. So you're not paying tax twice on the gain.
Because you've already paid once. You already paid.
Yeah.
I find it personally easier to think about this in terms of more abstract assets like stocks than I do to think about it as than I do to think about property. It just because those gains are often never realized. I think it's, for me at least, it's easier to get my head around the bill when I think about it in terms of stock holdings than if I think about it in terms of, like the kind of physical property that we tax into property tax. But that's just my brain.
And I can let this go for a while because I know we have a
Yeah.
lot of information to cover this afternoon, but yeah, I
Yeah.
mean, maybe another example. I only used the building because that was the example he gave us.
Yeah.
So I prepared a memo on this topic and it's in the folder for today.
Okay.
Representative Beck.
Thank you for the example. Boy, I really find this example terribly troubling because I think what a owner of a building is gonna do, say it's an apartment building, is they're gonna shift those wealth tax payments onto their tenants. And then in the end, the basis is gonna replace that and they only pay, I mean, you'd be shifting capital gains onto renters. Is what that would occur in that situation. That's what would happen.
So again, we're talking about assets well above $10 million.
Yeah,
Okay.
but I mean, that's what'll happen.
Okay, so for our next change for the amendment, it's on page 11, line 5 here. And this is where I added some clarifying language to avoid any confusion about how property would generally be valued when it's not offered to sell to the public. And then the next change is on page 16. This is clarifying language regarding what individuals are allowed to apply as part of their exemption to a trust. We haven't gone into trusts, but trusts themselves would not have a personal exemption. In this case, that would be like the 10 million excluded amount that we start with. Actually, for this, I think for the exemption would be the million allowed for category property. But at any rate, trusts don't have them, but individuals who contribute to the trust can use their own personal exemption and have the trust use that. So there's some clarifying language here about that. And then there's some more clarifying language below, which explicitly states that the exemption and exclusion amounts, what I was just talking about, assigned to a trust under the subdivision D shall not exceed the value of the property contributed by the individual. That is, a person couldn't contribute a nominal amount and then contribute their full exemption and exclusion amounts. Because allowing something like that would allow trust to be used as loopholes, which we did touch on, I think, in our first conversation a little bit. Then the bottom of page 31, the next one. Only have 2 more of these. This is a math thing. This has to do with, and this has to do with a topic we haven't gone into yet either, but it's these optional deferral accounts that the bill allows. When a taxpayer who chooses to use one of these ODAs, when they go to close the account, there's a lot of math done to find out how much tax is owed. And the change here is that if you see at the very end there's a negative t exponent. That wasn't an exponent before, so the math was going to be way off. And
Thanks for adding that exponent.
yeah,
That is why you're on the Ways and Means Committee.
So only world.
I did skip one. Sorry about that. Page 17. No, I didn't skip it. We covered that. So that's it. Those were the items that need to be cleaned up a little bit, and that we didn't have time for.
Thank you. Professor Gamage, welcome. Really glad to have you here with us. Would just love any clarity you could bring to sort of what this looks like, where else this is, a conversation. I know you're an expert in wealth tax.
Thank you. You can all hear me?
Yes, thank you.
Well, it's a real honor to be here today. Let me say a few introductory things, and then I'd love to answer questions in whatever order there are questions. So, as Kirby said, in a sense, this is only a timing change. If the income tax fully worked, this would only make items of unrealized gain tax sooner rather than later. But in practice, what this does is close the primary hole in the existing income tax, what tax experts have long called the Achilles heel of the income tax system, the fact that it's actually quite easy under current law for wealthy taxpayers who don't have salary income, who don't work for a living, but rather build asset value, entrepreneurs, financiers, and the like, to escape majority of income tax. The research suggests that multimillionaires in general are able to completely escape all income tax, federal and state level, on over 3/4 of their investment gains, because the idea, which is sometimes called buy, borrow, die, is do everything you can to not get current salary in forms of tax planning. Instead, pay yourself minimal salary and have asset appreciation, whether that's in the form of a business, real estate assets, etc. To the extent you need money for purchasing more stuff or living, borrow, and then eventually upon death, all of those untaxed gains goes away. There's a huge literature documenting numerous problems created by this problem in the income tax, including harms to economic growth, harms to the administratability of the entire tax system, holding back historically disadvantaged groups of Americans who aren't able to similarly enjoy these tax benefits. At the state level, for a state like Vermont, which has a relatively progressive income tax rate, there's further problems in that it's relatively easy, and in fact, there's strong perverse incentives for taxpayers who build substantial wealth living in a state like Vermont, benefiting from Vermont's services and protections, and build that wealth not through salary income, but through forms that are treated as asset appreciation. When it comes time to, say, sell your business worth $50 million or your real estate portfolio, tax lawyers will advise on moving out of state to a low tax state, even temporarily for a few years, so that all of those gains permanently escape Vermont, and economic activity is encouraged to escape Vermont also. So the idea here is to close this central hole in the income tax system to give Vermont the claim to wealth that is built up in the form of income, to the income from wealth built up while taxpayers reside in Vermont. So for a simple example, it's easier to start with publicly traded assets because there's other rules that apply for everything other than publicly traded assets, which I'll say a bit about in a moment. But imagine a taxpayer living in Vermont buys $1 million worth of stock in a publicly traded company. They now have $1 million of basis. Some years, decades down the road, they've done really well. The stock is now worth $51 million. So they have 50 million in unrealized gains. Under current law, Vermont gets no claim on any of this until there's a sale. And if the taxpayer moves out of state, there's never a Vermont claim on any of this, even though it was built up while the taxpayer was a resident in Vermont. Under this reform, after enactment, 50% of those unrealized gains would be subject to Vermont income tax annually. So in the first year, half of those unrealized gains would be subject to tax for a 25 million Vermont income tax. Basis would then go up by that 25 million. So the taxpayer would now have basis of 26 million. If the taxpayer then sold that stock, the taxpayer would get credit for that basis in the amount already tax was paid upon, and only the remaining amount would be taxed. And this is true whether or not it would ultimately be treated as capital gain or ordinary income for federal law. For anything which is an asset sale, for which the starting point for federal and Vermont tax is amount realized minus adjusted basis. So a question was asked, who tracks? The answer is the same as basis under existing law. for federal and state purposes. Taxpayer has some responsibilities, but there are worksheets provided with tax filings, and software does most of the work today. And it's actually quite easy. Software handles it much easier than used to be in the case. So what about for anything other than publicly traded assets? Well, first, this reform creates a $1 million exclusion for each category of asset other than publicly traded assets. And that's on top of the 10 million threshold for taxpayers to start becoming subject to this reform to begin with. So if you have, a 900,000 of gains from real estate, don't worry about it. That's less than $1 million. After that, there are valuation rules that explain how valuation can be done. But for each of these other categories of assets, taxpayers have the option either to be subject to the normal rules like we described for publicly traded assets with valuation formulas explaining how it's done, or they can open an optional deferral account. And the basic idea of an optional deferral account is if they don't want to pay tax now, they don't have to. They can just put it in this optional deferral account. But as part of that, they have to sign a contract with the state saying that Vermont has the claim to any wealth that the taxpayer was built up, the income from that wealth, while the taxpayer resided in Vermont. So taxpayers can't just escape eventually by moving out of state. Also, the optional deferral account rules are designed to be tax neutral, rather than, unlike existing law, where the first step of tax planning 101 is defer, the second step is defer until never, and finally escape. The optional deferral account rules are designed so there is no ultimate escape, that once if the taxpayer withdraws anything from the account, there's a withholding tax applied with a formula. And eventually, when the account is closed or reconciled, a formula is applied to make it equalize as much as possible and not tax advantageous to defer. So basically, the taxpayer gets taxed as though they hadn't the same amount over time as though they hadn't put it in the optional deferral account. So it's meant to be if you're building a business, you're an entrepreneur, and you don't want to pay tax on those gains now, fine, do an optional deferral account. But this isn't designed to be a tax escape maneuver. It's just designed if you don't want to deal with the tax now, and you're willing to sign a contract to deal with it later when you're ready to close that account and reconcile. So it's been my honor and privilege to work on this. This reform is designed based on cutting edge work around the world, in particular canton and province level wealth taxes in Spain and Switzerland, and also numerous federal level anti-abuse rules, especially the very successful Passive Foreign Investment Company, or PFIC rules. These rules have all worked well in practice, and we think they would work well.
Can you speak slightly slower? As a fast talker myself, I know that's very hard. But if you could try, that would be great.
Sure.
Thank you.
Nothing I said there needs to necessarily be repeated, but I'm happy to repeat any questions. Open for questions now.
Just asking for a general slowing of your role.
Absolutely. This is an ongoing problem for me. Apologies.
Me too. I totally understand. Oh, yeah.
So, question. What happens then if you pay capital gains as you're going along, and then the value of the asset goes down?
Yep.
Is it just an adjustment of the basis again, or what?
No, so the rules are designed, one of the reasons it's only 50% annually is so there are giant swings up and down. And so we don't have to worry about too much tax being collected and then refunds a year after year. So the rules for if too much tax is paid because the asset goes down in value is we wait 2 years. So the taxpayer can't claim it immediately because we don't want that volatility. But if the taxpayer has losses that are unrecognized, is the tax parlance, for over 2 years, then the taxpayer can then claim credit for the amount of those losses, but not in excess of the amount that was previously taxed under this bill. So to make it more concrete, imagine taxpayer in year one who has this stock that is currently worth 51 million pays that 50% tax on the unrealized gains, 25 tax and 25 million. The next year, the stock plummets down to value and is now worth, let's just say 0 to make the math easier. So the taxpayer can't immediately file a refund because we want to limit the volatility. But after 2 years, the taxpayer would be able to file for a refund of that entire 25 million, the tax paid on that 25 million, if the asset was actually worth zero at the end of 2 years following that first tax event.
Okay, that sounds reasonable. You said that this does look like a fairly complicated system. And your response was, well, they're tax software, things like that. So my understanding is that this is kind of new. And so Vermont has a very small number of people, and probably even a smaller number of people who would actually use this very much. So would TurboTax go through all the trouble to write the software that's going to track this with such a small number of people actually being able to use it?
Yeah, no, it's a good question. There are absolutely new elements of this reform. This builds on cutting edge work around the world and in the US, but there's absolutely new elements. For implementation, the starting point would be worksheets. The complexity here seems a lot on first impression, but I would say it's no more complex than what Vermont already does by decoupling with federal bonus depreciation. Taxpayers deal with that today. Now it's business taxpayers, but it could be taxpayers who have smaller businesses that wouldn't be affected by this reform. So it's similarly not the majority of Vermont residents, just those with businesses affected by bonus depreciation, but that could be a relatively small business. What happens today? There is software. The software, I would hope for bonus depreciation for Vermont, I would hope that software companies would similarly create software for this reform. It's not, that hard to create such software, but states decoupled with federal rules before software existed, and taxpayers dealt with it via worksheets. That created somewhat more work for accountants, and software has made life easier for accountants and taxpayers, but it's not like you need software to deal with complexities for capital gain. These complexities have been with us for 100 years, and states have chosen strategically to decouple from certain federal provisions, including Vermont, most recently with bonus depreciation, and taxpayers and accountants have had to deal with it for over 100 years. So I hope that software will be created. I think it quite likely because it's not all that difficult, but if not, I don't think that's an exorbitant administrative burden. I think it's within the realm of sorts of things that states have had to deal with previously, and taxpayers and accountants have grumbled about, but only grumbled.
And it does seem like the people who would be worrying about this would have accountants.
Yes. There's a reason. In theory, this is a better set of rules for everyone. Right? But why not apply this to everyone? Because it's more complex. And there's a lot of approaches in tax. The standard deduction is one of these. The standard deduction is for most taxpayers, we don't want you to have to go through the hassle of figuring out your charitable contributions and all your itemized deductions. So we're just going to make it simpler but less accurate. But for taxpayers who have enough resources or enough itemized deductions where it's worth the calculation, we have more complex but more accurate rules. That's the spirit here too.
Okay, good, thanks.
Just help explain to me, you're talking about a system where you believe that people are moving so that when this net income or gains hit, it hits them in a place or location where their tax liability is going to be less, and they do this all the time, and this is how they game the system. But if I believe that, then if somebody was in that situation, and Vermont had something like a wealth tax, they would just avoid the state entirely, wouldn't they? If that person had that, if that's how they're playing the game, Vermont's not on their list, right? Or am I getting that wrong?
No, respectfully, I don't mean to imply that these sorts of games are happening all the time. There's a literature I submitted, I don't know if you received it, but I submitted some written testimony with an attachment with a draft article reviewing some of this literature. The empirical research on taxpayer mobility finds that there's very small, much of it even negligible mobility responses to changes in taxes at state level or even abroad, except near death and retirement years. The one, a few other minor exceptions like professional athletes, but the one big revenue exception is state estate taxes and other things that apply near end of life seem to have substantial mobility responses. So the literature suggests if you're thinking about you want to start a business, where do you want to live? Well, it turns out that the vast majority of people starting businesses seem to want to live in California and New York, despite the higher taxes and much more expensive nature of those states. That's where the lion's share of wealth is created, much less so than decades ago, but still that's the case. But say you think Vermont is an attractive place to live. You look at you might look at the tax system, you might look at the social services, you might look at what it's like to hire and recruit there. The literature finds that taxes aren't a big factor for these decisions. By contrast, when people have already done what they're going to do in their career, they're ready to retire or in their near retirement years, and especially near end of life, Florida suddenly becomes pretty attractive. A lot of people seem to move to Florida, and the literature finds that they actually do move to Florida for tax reasons, and not just Florida, but especially Florida. And changes in estate taxes or other rules that apply late in life seem to have a significant effect on that. So what this would do would be, if you want to build a wealth in Vermont, great. Pay the same share that the successful doctor or anyone else who's getting salary income is paying living in Vermont. Be subject to the Vermont income tax and enjoy the benefits of Vermont. The literature finds that people find that attractive proposition. But once you're ready to retire, if you built up all that wealth in Vermont, enjoying Vermont services and protections, you shouldn't be able to escape Vermont's income tax on that just because you built your wealth and asset appreciation, you didn't pay yourself salary, and now you want to move to Florida.
So are you saying that, so let's zero in on Florida. What is it about Florida that's attractive to people? Is it their estate tax? What is their estate tax?
I mean, lots of things about Florida are lots of things about
From a
Florida.
tax standpoint, why at the end
From a
of
tax
life?
standpoint, the literature, let's acknowledge this literature isn't conclusive, and people move for lots of reasons. But the literature that studies broad numbers finds that the big effect is estate tax. People, states that have higher estate taxes and responding to changes in estate tax tend to have a lot more wealthy people move out of state post-retirement or close to retirement, and especially close to death. And they primarily seem to move to lower tax states, especially Florida.
And and I just want to clarify, you were saying like within the group that moves, which is not the majority, that is sort of the effect there.
Well, lots of people move. The literature tries to figure out, are they moving for tax reasons or other reasons?
Yeah.
Recently, there's been substantial movement out of states with high real estate prices and to states of lower real estate prices. And even with a lot of the people moving end up paying higher tax when they move to states with lower real estate prices. But if you can sell a modest home in California or New York City for millions of dollars and then buy a great home in Texas or wherever, that's causing a lot of people to move, the literature suggests. The literature suggests that it's not for tax reasons that they're moving. And primarily the only time when substantial numbers of people seem to move for tax reasons is post-retirement.
We should just get rid of the estate tax. I mean, it's a small volatile segment. I know a lot of people move out of my area. They go over to New Hampshire just to beat it. Maybe we should just get rid of the estate tax. It'd be a lot simpler than this.
You could get rid of the estate tax and add the wealth tax to make up the difference.
No, let's get rid of both of them, build our revenue.
And the trend.
I'm intrigued, but I didn't know this about the estate tax, that you've read this in literature, but So if you saw a graph and you saw that people in Vermont, that the income in Vermont is mostly is the highest in people 55 and over and then 65 and over. And you wanted to keep them in Vermont. Would you say because you want to keep people who've got money in Vermont, then you would probably say to get rid of the estate tax.
I guess I just
really
want
want to hear his answer.
okay, and I just want to offer for after he gives his answer that we have actually an expert on wealth flight coming in tomorrow for testimony, I think, it's tomorrow. And we can bring the estate tax sort of into a conversation, but the bill we have in front of us has nothing about the estate tax in it at all. So I'm happy to David answer. I just want to make sure that afterwards we go back to the bill that's in front of us and make sure we understand the bill at hand. Carol.
Because this is, to me, very interesting.
So the connection to this bill is one of the key problems with the income tax is the federal provision known as stepped up basis on death. And this has been tried, there's been proposals and they've actually been enacted multiple times to reform stepped up basis on death, but it's hard to fix for a variety of political and other reasons. So effectively, the income, any deferred gains, unrealized gains of taxpayers goes away forever at death. And one of the reasons we have the estate tax is it's meant to partially make up for that. That was the original understanding of the estate and gift tax in part, and the integration between the estate and gift tax and stepped up basis on death. If you implement this reform or something like it, you no longer need to worry about the problematic consequences of stepped up basis on death. So right now, we don't have a literature. I mentioned the state tax because that's the literature we have. We have variation in estate taxes. And the literature suggests, I'm a tax lawyer, not an economist, but the literature suggests that mobility responses to the estate tax are much larger than anything for income tax purposes. Whether those mobility responses, they're still, not so much that estate taxes don't raise revenue. But the point for this bill is we don't have literature on what would happen for states getting rid of all the problems caused by stepped up basis on death because no state has done that before. But you can reason by analogy to what the effects of this bill would be. For my 2 cents, but this is if one was to discuss replacing the estate tax with a reform like this, I think that would be, assuming that it was done with the right rates, revenues, et cetera, that would do great benefit for a state like Vermont. But just this reform on its own solves or should solve a substantial portion of those tax avoidance related life moves.
Other questions?
Could this bill pose a problem in a recession? And just kind of like an example, say for 10 years in a row, things are going great. $5 million a year is paid in by these taxpayers based on their wealth.
Mm-hmm.
So you got $50 million. Economy goes in the tank. 2 years after, all these people ask for refunds. And the state of Vermont has to give back $50 million in refunds, which in our budget, that sticks out quite a lot. Is that something that could happen in an economic downturn?
So that's the primary reason why this isn't 100% deemed realization. It's 50% annual deemed realization, and there's a delay for losses. I would say that problem already exists. I don't have firsthand, this problem is huge in California, despite numerous reforms done to address it, but it's a problem everywhere. It exists because when the economy is doing well, people have gains, and when they do sell assets, they all of those capital gains, or almost all of them, accrue when the economy is doing well. And then when people sell assets during the downturn, they're getting built-in losses or realized losses. And this is a huge issue with many states. Again, I'm not especially familiar with how this plays out in Vermont, but I'm familiar in other states that increases revenue volatility along with economic cycles. This reform would both in some ways exacerbate and in other ways alleviate the problem. It would alleviate the problem because we'd be taxing built-in gains gradually over time, but always with a lag. As long as assets are going up, we're never going to reach 100%, 50% each year. So that means if, the taxpayer I started with, if in year 1, they pay tax on half of their built-in gains, year 2, half of the remainder, as long as the assets are going up, we're never reaching it. That means if in some subsequent year the assets go down, they would have to go down by a lot for there to be losses that would be triggered by this bill. That could happen, but an ordinary downturn wouldn't trigger much of this. And then even if it did happen, even if we're talking about the next Great Depression or, even the Great Recession, there would be that 2-year lag for taxpayers to claim refunds. So it's possible that your scenario could definitely happen, but my sense is that it's much less likely to happen as opposed to current law, where we already have the problems of realized gains and losses.
They also offer that there are recessions where capital still profits significantly. And I think more and more every year, economists will talk about the fact how much sort of the real behavior of our economy has become almost entirely divorced from the stock market. You had it, Brandon.
Yeah. Chris, I think the way I heard your question, it was more that those losses, once paid in tax, would be refundable. And I mean, I don't see that in this bill. I see someone pays tax on a gain, then they take a loss. That loss just counts against future tax. That's the way I read it.
Yeah, I would drop it different.
Professor, can you talk a little bit more about what other states are doing around this issue? I know this is kind of a unique bill, but if you could just fill us in on other states and how they're trying to deal with the same sort of issue around taxation, I think that would be helpful.
I mean, it's not a unique bill. We previously drafted and were proposed in similar reforms in New York and Illinois. Neither have passed, and we have no expectation that they're going to pass in the near term. And this is a more developed version of those bills that has incorporated the learning and research we've been doing and innovations at the federal level over the last few years. Some other states have proposed wealth tax reforms rather than mark-to-market income tax reforms. We've designed wealth tax reform for California and some other states, and worked on ones for Washington State. But in the near term, no state is on the brink of enacting such a reform, right? There's lots of states working on proposed legislation for such reforms. So what are states doing about these problems? The answer is they're suffering, in my view. There's some minor reforms that some states have enacted to address certain aspects of this problem. The revenue of the volatility aspects, for instance, California has a reform to deal with that specifically that was passed, and minor anti-abuse rules. But this is a problem that affects all states with a substantial income tax, in addition to the federal government. And President Biden's signature reform proposal, the billionaire minimum income tax reform, would be one way of addressing this problem at the federal level. But that's not going to pass. Will Republicans have the House, and there were the votes for it in the Senate prior to that. So I'm not sure what else to say that's helpful in that question.
Thank you. That helps.
Can you tell us a little bit about the other countries that do this?
Yeah, I mean, no country has a comprehensive mark-to-market reform of this sort. There are lots of partial mark-to-market measures that have been implemented in a variety of places, including at the federal level, especially the passive foreign holding company. Passive foreign investment company rules, the PFIC rules, which are designed at especially troublesome international forms of tax avoidance. And several other countries have subnational province or canton level wealth tax reforms. Wealth tax is more traditional. It assesses and in the US, actually, most states used to have a general wealth tax. That those became today's property taxes with much narrower bases as states adopted income taxes. But Spain has a recent subnational province level wealth tax in every province except Madrid. And Switzerland has had canton level wealth taxes for over 100 years. That's the prime, as a substantial revenue raiser for Swiss cantons. And so this proposal builds on a lot of mechanisms in those wealth taxes, primarily valuation mechanisms. But the difference between a income tax mark-to-market reform and a wealth tax reform is that in a wealth tax reform, you just look at the value of whatever it is, like in a local property tax, and you apply the tax rate year after year to that value. In an income tax mark-to-market reform, you're just trying to tax gains. The difference between a mark-to-market income tax reform like this and a realization-based income tax, like the federal and state income tax currently mostly is we're not waiting for sale. Because when you wait for sale, that opens all sorts of abuse, tax planning and deferral opportunities, and eventually seems for very wealthy taxpayers that most gains never get taxed.
David, I'm just going through my head and thinking about different scenarios, but have you, a lot of investments, there's no income associated with them until sale, IPOs, venture capital, that kind of stuff. I mean, have you given any thought, and I mean, Vermont doesn't have the size to make any impact on the rural markets or anything, but like if a country or a big region went to this, where people would be like, okay, I'm gonna venture capital or an IPO, there's no income from that investment, but there's gonna be a tax coming, there's gonna have to be money to pay those taxes. What would that do to those higher risk low income or no income markets that are out there? I'm just talking about capital investment in general, the stock markets.
Yeah, I mean, this is a reason why we designed the optional deferral account system, which we've in other states and at the federal level for President Biden's reform called the unliquidated tax reserve account system, because ultra sounded cute to us at the time. And the idea behind the optional deferral account system for Vermont, or the similar systems we proposed at the federal level or for other states, is in the Vermont reform, for anything other than publicly traded assets, you don't want to pay tax now. You have a startup company, for instance, you want all your resources invested in that startup, fine. Just sign a contract with Vermont so that Vermont will get its share of the gains built up while you live in Vermont. And then you don't have to pay tax unless you take money out of that or until you eventually sell and reconcile it. There's a reason that similar mechanism was built into President Biden's billionaire minimum income tax reform. If we didn't have those deferral mechanisms, there's a lot of economics literature on your question. I think it's fair to say we don't have conclusive answers, but my read of the general answer is when we're talking about very wealthy taxpayers and businesses, it's relatively easy to borrow at extremely low rates. And so the liquidity problems that you're imagining don't seem to exist in practice when we're talking about really wealthy individuals, families, and businesses. That said, I do think that having a system like the optional deferral accounts makes sense. And for anything other than publicly traded assets, which are effectively money, right? It's very easy to sell publicly traded assets or borrow against them for liquidity purposes. But anything else, in some ways, the optional deferral account system is overly broad or generous, but should solve any of those liquidity issues. Anyone who has real liquidity issues can just use an optional deferral account.
Thank you.
Representative Anthony?
Thank you, Mr. Gamage. I suppose if we go ahead with this kind of strategy, this is in one sense found money. That is to say, we have no reason to expect we'll ever see a return if we don't go ahead. On the other hand, if we do go ahead, it sounds to me like the proceeds from this, particularly when a wealth accumulator begins entering into these agreements that you spoke about to essentially pay forward, will create a kind of a lumpy, if you like, proceed system. And I guess my own one nervousness is that because of the lumpiness, you better not begin to budget and depend on this source of revenue on a regular basis, because in fact, it comes and goes depending on the density of the universe of people who are entered those agreements and when they did.
So this is another reason for the 50% instead of 100%. Older versions of these sorts of proposals didn't have this only 50% mechanic. I think my co-author Darian Shansky and I came up with this idea a few years ago to address the revenue volatility problem and exactly this problem you're discussing. And the design here is meant to have smooth and more or less steady revenues over time. Now, again, I'm a tax lawyer, not an economist. My collaborator, Emmanuel Saez, who's an economist at UC Berkeley, has done some analysis for other states that suggests that this smooths revenue more or less, rather than being overly front-loading it or overly back-loading it. But he hasn't done that analysis yet for Vermont, so far as I know. But my sense is this is designed to have a smooth revenue stream over time. And if anything, it might be overly backloaded because the optional deferral accounts here are broader and more generous than in prior proposals we've drafted, right? So for everything other than publicly traded assets, taxpayers can choose to do the optional deferral account. And how many will make that choice and at what level is, we can look at the experience with the federal PFIC rules for some guidance, but there's some speculation here. So it's hard, I certainly wouldn't say this is literally going to be smooth over time, but nothing is. The ordinary income tax for salary income isn't smooth over time because the economy changes in lumps and bounds, but this is neither designed to purposely front load revenues or to purposely backload revenues. And it's designed to be as smooth as much as we can predict such things.
Just to follow on, logically, you don't have to be an economist to speculate that the density of the universe of people who elect that is what either assures volatility or the lack thereof. Is that logic work for you?
So, there's two provisions that smooth things out. The first is this 50%, right? That's for anybody subject to tax. That's not an option. That just is how the law works. And it means that we're not 100% built-in gains would have a huge first-year revenue. 50% smooths it over time. Now, if that was the only provision, there would still be higher first-year revenue than subsequent year revenues, but much less so than 100%. The second provision is the optional deferral accounts, and absolutely, we can estimate roughly how many people will elect into the optional deferral accounts with what percent of their built-in gains, but this is going to be, we don't have precise estimates. And then once they elect into it, how long are they going to keep their stuff in there, and how many withdrawals are they going to make? This is going to affect how smooth the revenue is over time, and we can estimate, but we can only estimate.
Thank you.
Representative Lewis?
Thank you. I'm going to go back to if you're in year one and you have publicly traded shares and it's $51 million, and then it's the 50% on that 25 million, and it plummets to zero, and then the taxpayer waits 2 years, then gets the refund of the entire tax paid because it went all the way down to zero. The state really can't use any of that money. It'll have to put it in an escrow account or something until either the person sells the stock or dies, because otherwise, how's the state gonna come up with the money to pay all that money back?
So one, this is a feature of current law has net operating losses for business and a number of other provisions that work similarly. In practice, these do create, they're part of revenue volatility. We can't perfectly predict revenue going forward, and during economic downturns, revenue goes down. During economic downturns, revenue goes up. The odds of the economy being 100% destroyed so that all applicable actors have zero value in their assets, that's Armageddon. We have bigger problems. That even in the Great Depression, if the Great Depression happened again, Vermont would have revenue problems under existing law. I suspect this proposal would make those revenue problems not as bad as compared to existing law, even though taxpayers would be claiming refunds. Why? Because each year we would not reach the amount of built-in gains. Now, this reform would stop collecting revenue for the most part right after a Great Depression, because the refunds right after the Great Depression would exceed, some people would still be paying additional tax because we hadn't caught up to their prior built-in unrealized gains, but probably the refunds after the Great Depression would exceed. But under current law, that already happens. Taxpayers can sell capital losses, and business taxpayers have net operating losses, and Vermont's business taxpayers claim refunds on priorly paid taxes. And if the Great Depression happens again, Vermont's going to have a big revenue problem, as is every other state. Whatever effect this reform would have compared to existing net operating loss provisions is going to be relatively minor.
I guess here it's minor. If we've spent in revenue, and then let's just say it's 10 high individuals who live in Vermont all bought some stock A, and that stock all plummets. So there isn't Armageddon. There's just people who are owed money 2 years later.
So a substantial recession is the stock market usually falling like 10%.
But I'm not talking about a recession. This is just particular 10 people who maybe they had lunch one day and they all bought a certain stock. And then 2 years, and then it drops. And then 2 years later, they're owed the money. What they have, would it be possible that they would possibly sue the state of Vermont and say, we need to know that there will be revenue available to us to pay us back? I mean, what are we really, if we owe somebody something for sure, based on the price of something going to zero, does that create an obligation in the state to do more than just hope that there'll be revenue to pay back? Do you have to have a bond? Do you have to have anything? That's anything.
Exactly the same laws governs current net operating losses for business taxpayers. And there is no actual, it's actually quite common for states during downturns to delay net operating loss rules, and the federal government has done this also. So there's no, there's a moral obligation perhaps, but there's obligation only insofar as Vermont recognizes that obligation, if that's your legal question. But this is part of revenue volatility. When economies decline, business taxpayers file net operating losses for prior taxes paid, and unless states change the law, they get refunds. And this is partly why in every state, when there's a downturn, revenues go down. There's similar income tax provisions, but the big ones under current law apply to business taxpayers. But this is both publicly, this is both corporations, this is partnerships, this is all business taxpayers, and this is a big deal. This is a big part of revenue volatility. You're absolutely correct that in a sense, for extremely wealthy individuals and families, this reform would treat them more like business taxpayers are currently treated. But but to partly compensate for that revenue volatility, and we think probably more than compensate for it, the 50% rule means that we would never actually catch up to gains. And in a typical recession, we wouldn't see that loss of revenue. It would have to be a gigantic, or, it would have to be a Great Depression level recession for revenues from this reform to significantly decline, or something really idiosyncratic. If it's just every wealthy taxpayer in Vermont invests all of their revenue in crypto, and the crypto market plummets, that would be a localized economic catastrophe, but that would already create all the problems you're talking about under current law in Vermont. Now, are there budgeting rules? Should this be, should states account for revenue volatility in budgeting? Yes, they should. And good state practices already do involve rainy day funds and other measures to account for
And
volatility.
we do all of that in Vermont and then some.
Okay, thank you for that answer, because I think I find. Right.
David, is there anything else you want to share with us today?
No other questions from the committee?
I don't think so, no.
Okay. Let's just end by saying, for close to 100 years, tax experts have universally recognized the massive problems created by relying on a realization-based income tax, especially for the very wealthy. There's massive documentation of economic harm, various sorts of unfairness. It makes it extremely difficult for those who weren't born into advantage, who have to rely on heavily taxed salary income, to catch up to those who are able to borrow from friends, family member, or who are able to start life in privileged sectors like finance and real estate. In mine and many, many other people's opinions and experts' opinions, reform is needed. This is a carefully drafted reform that we think would address these various problems that plague Vermont and other states, and to some extent the federal government. And I'd be very happy to answer any follow-up questions anyone might have. You can reach me via email otherwise. So thank you.
Thank you. And this morning we spent some time talking about things like sales tax versus property tax in terms of its progressivity. It is sort of a really interesting artifact of our tax system that we tax in earned income higher than we tax unearned income, given what that says about sort of how we value people's time and efforts. So thank you very much for joining us, David. I really appreciate it. Committee, we are going to break for the day. We have our bill on the floor. The flooded property abatement bill is going to be put in all stages of passage, ideally with rules suspended. So hope we can all be there and support our reporter, Peter Anthony. Thanks for carrying that for the team. And